Now, consumer price inflation has remained on the upper limit of the Reserve Bank's target range for the third consecutive month. According to the latest figures by Stats SA, inflation in June reached 7.8%, up from 7.4% in June. That's inflation in July reaching 7.8%. Let's unpack this further now. We're joined by Frank Blackmore. He is the lead economist at KPMG. Mr. Blackmore, thank you very much for your time. So, a lot of the times I've asked whether or not we are in a technical recession as an entire globe, and economists have told me that absolutely not. But here in South Africa, our inflation is close to where it was during the global financial crisis. We're just 2% far from that 8% inflation rate. So what really is going on then if it's not a recession?
Well, I think one has to look at the root cause. Remember, the previous time, as you correctly said, was just after the financial crisis, and then the world was really in a recession. It's still unknown whether the world will return to a recession based on increases in interest rates, subduing sort of economic activity globally. But the cause of our inflation currently is obviously the crisis in the Ukraine, Russia's invasion thereof, and the consequent increases in the prices of both energy as well as food. If you've lived in South Africa over the last few months, we've seen an increase in prices of fuel, especially in each month, except for this a gradual decrease in August. So fuel reached a peak in July, and therefore it was unsurprising that inflation would also reach that peak in July. I think there's still a lot of uncertainty about what the future will bring, but regarding inflation, I think the good news may be we're nearing the top of the inflation cycle, and perhaps the remainder of this year will see slight decreases in the rate of inflation for the rest of the year.
And as a country, we have, of course, heard some good news in terms of our unemployment rate. Not great, of course, because it's still quite high. We've heard that petrol is expected to go down once again the first Wednesday of next month. So that's good news. So what you're telling me is that the possibility is that we've already reached the peak of this terrible period.
Yeah, I think, look, unless we get, you never know what's coming around the corner.
Yeah.
There can be further shocks to the global economy. But if we look at the main drivers of this inflation, and one of them is definitely the fuel price. Fuel price has come down both in August, and as you said, it will come down next month as well. And that's sort of a good sign, because both fuel and food, especially fuel, are unavoidable if you want to interact within the country. So you can't go anywhere without transport. And we all consume food, so we're all consuming these increased prices. But on the counter side as well, when there's a decrease in that fuel price, that also will lead to or a decrease in the rate of the fuel price increase. That will also lead to lower inflation in the months that are coming.
So obviously then there's good news in the horizon. We might not be paying less for food immediately, but it will be happening quite soon, right?
Yeah. Remember, we're still paying more,
yes,
but the rate of increase is slower. So unless we have negative inflation or deflation, prices are not going to go down, but the rate at which they increase will slow down. So I think that's an important thing to keep in mind as well. And we know we're near prices reducing, except for the fuel price, that is.
Did you expect that it would be 7.8%? There are some economists who are telling us here on ENCA that they expected it to be much worse. So they are feeling more positive because of the 7.8%, even though it feels very high to the consumer. Did you expect this type of rate?
Definitely, given the peaks of the fuel prices in July, we were also around the 7.8, probably a little higher than 7.8 for July. So, one can't really be pleasantly surprised, given that it's still the peak of inflation at this point, and way above the 6%, which is the upper limit for the Reserve Bank. And obviously what this means is, for the two remaining monetary policy committee meetings, the Reserve Bank is probably going to increase those interest rates again, ending the year with a repo around 6.5% and prime around 10%, which is sort of getting us back to where we were in the period pre-COVID. So I think if one has debt out there, the price of that debt will increase in the foreseeable future based on those increases in interest rates at this point.
And of course, we know that prime, in terms of borrowing, for instance, a house, etc., is now at 9%. Are you seeing that also? Obviously, it'll be a knock-on effect. As soon as things start going down, at least there'll be some relief for consumers quite soon. Maybe we'll have a good Christmas.
I think those rates are set to increase further still. But what happens afterwards or next year would likely be a decrease in this inflation rate, and that may lead to some respite on the interest rate side as well. Remember, what happens is, for example, the July number that you mentioned, 7.8, measures prices in July 2021, and it compares them to July of this year. Yeah. And because of the increase, the 7.8%, it's unlikely that a similar increase will happen to next year, July. So when we're sitting in next year, after this year of quite elevated inflation, it's likely that we get a lot lower inflation next year once more, and that can lead to perhaps interest rate decreases towards the end of next year again.
All right. Well, thank you very much for that explanation, and thank you for speaking to us. That is KPMG economist Frank Blackmore.